what are the pros and cons of going direct to the bank versus private credit? Because that's what a lot of people would be asking right now.
So when everyone's talking about private credit, it's not new, it's old, it's just relatively new to Australia, but growing really quickly. And why it's growing quickly is because everyone knows Australia has 4 major banks and they do the exact same things. You've got one colour, but it's black. That's it. So it's interest rates, but there's no flexibility there.
Something I've picked up, your LVR is higher. That would generate a lot of interest from our listeners. Like max LVRs, we're finding it like 70%. And ANZ used to do 80, but only on like a 1.5 mil sub loan, like tiny stuff. But generally it's about 65% LVR.
We're a debt house, so you know the house always wins. So if you take a long-term view of New Zealand being a good place to invest, and I think it is, it could be a great time to buy while the market's sort of sloshing around the bottom, in my humble opinion.
And then the rates drop and they're like, oh yeah, I want more money now. It's like, well, we're still the only buyer here.
Good day, how you going? Phil Tarrant, co-host of Inside Commercial Property, back in the studios with Scott O'Neill, man behind Rethink Group. Scott, how you going? Good to see you again.
You too, mate. Episode 65.
I know, who would have thought?
We would say, but yeah, it's just crazy numbers. But the listeners are great. We're always just trying to find the next guest, and this one will be interesting. We've been through all
the good ones, and now we're sort of at the second tier stuff. And there's maybe a metaphor for that, for where we're going to go with funding. But I see you got the memo with the shirt today.
You look good, mate. It looks good.
I thought, linen shirt's not normally my look. It's more like your deal.
Things are getting more relaxed, isn't it?
Yeah, it is. We used to wear a suit every day before COVID, and now very rarely.
Everyone wears sneakers to the office, and post-COVID, everything's different now.
Yeah. Hey, did I see you guys up for an award for innovation? The Innovation Awards in a couple of weeks' time?
Yeah, that's next week.
Is that next week,
I think. I don't know. You organise them, don't you?
I just saw your name somewhere and I went, oh, that's interesting. So
it'd be good. Yeah. So it's been a good year. Business has been very strong, and we're doing all sorts of things with AI to changing systems to always trying something different before others. And it's been good.
So your sort of approach to innovation is that most people think innovation means technology, but it can mean a whole bunch of other things as well. It's how you think about things, how you deploy different tools and tactics in your business. So you seem to be leading. I saw a little graph the other day, or a little circle thing of all the different parts of your organization now. So it keeps expanding. Yeah,
there's 8 businesses currently, and there's another 2 before the end of the year. So those 2 will be quite exciting because they're both very different. So we'll announce them in time, but that'll take it to 10, and I'll be probably too busy after that.
Yeah. Be careful what you wish for, mate. It's a lot of things to manage and control, but we're not here to talk about just all these many myriad different businesses you have today, but obviously, no doubt, the common thread of everything you do inside your organization, supporting your clients, is going to be access to capital. Yep. We all know that as property investors, whether resi or commercial, access to capital to continue developing your portfolio or shuffling around assets in your portfolio, or even selling down your portfolio, expanding it. Access to capital is key. And it gets harder and harder for many Australians to actually access, though, particularly if you're active. So you've done it very successfully in your own portfolio. I know you help your client base around that, and you've got a pretty expansive connected network to help people out with that. You have your, obviously, Rethink Finance, when you do a very good job helping Aussies secure funding, largely from the banks and other lenders. But today we thought we'd expand that a little bit and get a sense for what's happening in other aspects of securing capital, and that is within private credit, something I'm sort of familiar with. I've been covering it in other aspects of our business for quite some time, but for many of you, you might not yet know too much about it. It's a word you hear bandied around. So we're going to get stuck into it today and learn a little bit more about it, how you can use it to leverage growth inside your portfolio, and importantly, how you can expand the ways in which you can secure financing. Joining us in the studio, Dan Gallen is Executive Director and the Chief Investment Officer of Pallas Capital. How you going, Dan? Good to see you, mate.
Good. I'm going well.
You look like a guy who works in private credit.
Really?
Yeah.
I was thinking about it. Is that a compliment or an insult?
It's a compliment. It's a compliment.
Okay.
Yeah. Relaxed but serious. So what's the background? How'd you end up in this game?
I've been lending and doing some development and investment for over 20 years now. Started life as a broker, actually, of all things.
What sort of broker?
Commercial real estate.
Commercial real estate broker.
And then sort of started my own advisory business, and then met my business partners through that process. And we started Pallas Group in 2016. The next year we'll have our 10-year anniversary. And, that business has grown incredibly well. We started with 3 founders, and we've now got 200 staff. across a bunch of offices in Aussie and also in New Zealand. We lend about 300 million a month now off a standing start. So it's been a great ride for us. And we've really ridden a wave in the private credit space, and, happy to be on the show today and talk about that, and, how it might be available for some of your investors to use as well.
Yeah. And so tell us about private credit. And I think let's assume no one knows what it is. That's probably the best way for us to go with it. And it's a nice way for me to sort of dial in and check some of my assumptions about what I think it is as well. So always use this as a way for me to educate myself. So what is private credit? I'll
give it a 30-second history lesson.
Yeah, let's do it.
Private credit is non-bank lending. It's just a fancy way of saying non-bank lending. In the States and Europe, non-bank lenders are responsible for around 55 to 60% of the overall lending markets for commercial real estate debt, and that includes property development. In Aussie, we're about 12 or 13% of the market. The rest is done by the major banks and other ADIs. When we started the business, it was only about 6 or 7%. So it's growing really quickly here, but off an incredibly low base. So when everyone's talking about private credit, it's not new, it's old, it's just relatively new to Australia, but growing really quickly. And why it's growing quickly is because everyone knows Australia has 4 major banks and they do the exact same thing. So what private credit provides investors is optionality, service, if nothing else. We move quickly, and we provide options around leverage and structure that the banks simply can't. So we're stepping in and filling a void, and that's been incredibly well received, as you can tell by the growth in the overall share that private credit or non-bank lending is taking of the market. So this isn't here for the short term. It's just going to keep growing and growing and growing. And we see this being a 55, 60% share of the market like it is overseas in time. So it's a good time for investors to get a real good understanding of where this market's headed and how they could be a part of it if it's relevant for their business.
So far you've done about 10 billion in structured real estate transactions. So what did you say the current market share is here in Australia?
It's about 12 or 13% of the overall market.
Is that resi and commercial?
Just commercial real estate debt.
Yeah,
commercial real estate debt. It's funded by non-bank lenders. So, and it's grown at around 25% per annum, the non-bank lending share. Overall credit growth in commercial real estate lending has grown for around 3 or 4%. What that's telling everyone is that non-banks are growing way, way quicker than the overall market. So we're taking market share off the banks. And that's a trend that's just going to keep going, in my view.
So what are the pros and cons of going direct to the bank versus private credit? Because that's what a lot of people would be asking right now.
Well, banks got one reason, and that's one reason is pricing.
Yeah,
that's it. So you've got one color, but it's black. That's it. So it's interest rates, but there's no flexibility there. So what the banks can do, non-banks, is provide a bit more structuring or things like leverage, pre-sales, can provide shorter duration, but with prepaid interest rather than servicing from your own pocket while perhaps you're going through a lease-up phase, things like that. So it's just flexibility. In Australia at the moment, a lot of the non-bank lending is what we call bridging loans. So it's shorter-term stuff. It's probably 15 to 24 months with a view to trying to then move that property back into the banking system and at a lower cost of funds. So it's providing a bridge to lower cost of funds down the track. But from a return on equity perspective, it can be a hell of a lot better than what the bank pricing might offer.
Interesting.
Or bank structure might offer, sorry.
I can't see the banks relinquishing market share easily to this subsegment. But if you look at Europe or the US, it's a significant market share. So what are the banks going to do, or what's going to happen?
They don't care. It's home loans. They love home loans. It's easy. They don't have to hold as much capital to do them. This is harder work, what we do. They lose staff to groups like us. They're happy just doing home loans. They're happy to do it.
So it's very similar to the mortgage broking industry in general. Because if the industry is sort of at, 65% market share from home loans?
75
now.
75%.
And that just keeps creeping up.
Wow. Yeah. 75% is what? Is through
brokers.
Through brokers,
of all home loan origination.
Well, it's service, isn't it? Those guys get paid off commissions. Yep. So, they're like a rat up a drain pipe to get the deal done. So it's good service you get out of them. And they provide optionality around pricing and structure, don't they?
It's about choice, right?
Totally.
Mortgage brokers providing choice for Aussie resi investors. I know a lot of mortgage brokers, they have a really good connectivity with non-bank and second-tier lending inside of resi mortgages. And I think we're sort of a bit beyond, maybe some of the stigma around sort of second-tier lenders or non-bank lenders 10 or 15 years ago. It's where you went when the bank said no.
Yeah.
And it's very, very different now because, credit policy, for those of you who are familiar with resi lending, is a little bit more flexible. They look at things differently.
Yep.
For self-employed borrowers, they can be a lot more flexible. They don't have a lot of the same rules that might govern serviceability inside the major banks. That's one of the reasons why non-banks in resi is growing. And what you're saying is that the same should be consistent in commercial.
Absolutely. And 80% of our business comes through brokers as well, especially in that sort of sub $20 million loan size that we deal with. It'd be 80% broker introduced. They do a great job and they're a big part of our business. Yeah, what you said is correct. I think non-bank lending sort of came from, people who would have heard about it 6 or 7 years ago would have thought, solicitors funds, super high rates, bit sharky, that kind of reputation. In our business now, we've got Morgan Stanley, Goldman Sachs, Westpac out of New Zealand, and Aussie Bank all funding our lending programs. They're sophisticated programs and got a lot of governance and rigor around them. So the market has really changed.
So just simplify that, and the way you just structure it there is pretty sophisticated. What you actually do is that you essentially get the funds from someone else and some very large financial institutions globally, bring it to Australia, package it up, create the products around it, set interest rates and any of the policies that govern it, and make that available to consumers of commercial property.
That's pretty good. Yeah, in a nutshell, that's right. So we call them warehouses or funding warehouses. So, for example, the recent one we settled had Morgan Stanley in the warehouse. So it's, as you said, it's a pool of funds. We have Morgan Stanley, another US asset manager, and Pallas Capital, Pallas Equity in the structure. That fund's around up to $500 million. It's got a set of rules around it. We can lend up to say $35-40 million, certain LVRs, geography and a few other parameters there. So long as it's within those parameters, we can go and lend that money out. It's our credit decisioning.
Yep.
So we get that at a certain cost of funds. We lend it out for a little bit more than that, not too much because we're not greedy. And then we make a bit of a spread on that. And then off we go. So we just keep putting together those warehouse structures or different loan types. So we might have one that specifically targets loans of up to $6 or $7 million, ones that do up to $40 million, ones that do development finance. And you just package these funding platforms up. And then, as you say, off you go. We're out in the market to originate new loans, manage those loans and make sure we get repaid and keep doing it.
That's the important bit, right?
That's the important bit. Yeah. It's easy to lend it. It's, we've got to make sure it comes back. It's a boomerang.
The defaults are quite low at the moment too, aren't they? Like, especially from the early days, it has changed the industry a lot.
Yeah, they are. Our book runs at sub 2%, generally speaking, which is very low.
That'd be mostly construction values, or it wouldn't be much of the passive stuff, would it?
No, it's not. And none of it's terminal either. It might just be, borrowers getting in a bit of trouble, need a bit more time to exit out of a loan. You're talking sub 2%, on a $3 billion portfolio. It's a small amount of the overall book.
Yep.
So, default rates have been pretty good in the cycle.
Yeah. And what's the argument like to go just straight to private lending? Like, there's obviously an interest rate penalty, which is the main deterrent. Like, how is it even a fair question to ask, like, how much more is the interest? I know you're going to say every deal's a different sort of risk profile, but what are we looking like? Interest right now for banks is somewhere around 5.75, 6% for off a CBA type loan if you're clean. And there's obviously some penalties if you're not, or shorter whale or whatever. Where's private lending at?
For smaller loans, sort of sub $7 million, you're probably looking at about 1.5% wide of where the banks are. But the leverage will be higher. There'll be more flexibility around debt servicing, which is important because the banks can be very strict around that.
Okay.
That can be difficult to achieve debt servicing where the interest rate environment is today and what net rents are getting kicked out of these properties. It can be difficult to hit that sort of 1.5 to 2 times interest cover the banks need. So we can get a bit funky on that and do a bit of prepaid interest mixed with a bit of rent to get around that for a period. So the margin differentials aren't that much wider. And then they get a bit wider the larger the ticket size because there's a bit less competition, maybe a bit more risk, that sort of thing.
Something I've picked up, your LVR is higher. That would generate a lot of interest from our listeners. Like, what are we... Like max LVRs, we're finding at like 70%. Remember ANZ used to do 80, but only on like a 1.5 mil sub loan, like tiny stuff. But generally it's about 65% LVR. What about in the private space?
Our smaller ticket will be at 75.
Yeah. Okay.
You know, so if you're looking at bringing a partner into that deal to help equity fund it, you know, if you can get money out of us in the mid-high sevens, it's pretty cheap equity for that last bit. You know, the banks for larger ticket commercial loans, I'm talking sort of $15 to $40 million now, they're generally at 55 to 60 LVR.
Yep.
That's where they tap out. You know, we're still doing 70 as a standard there. So, you know, that's on those larger tickets, that's a material amount of money. So, again, if that asset's going through some sort of lease up or value add strategy where over an 18-month period, maybe you get a reval and you're back down at that sort of 60 odd and you're back into the banks, it's just a nice way to bridge that period without chipping in material amounts of equity to get that loan settled down.
That'd be very popular with fund managers at the moment, no doubt.
Yeah, we're actually doing a bit, even non-recourse lending for syndicators, doing a bit of that. Properties have been revalued in a high interest rate environment, so there's been needs to chip in extra equity. You know, if a tenant leaves and you've got to fund refurb works, things like that. So tapping a bit of debt rather than going to the market for more equity has been a good way to not dilute positions in a you know, in the current market.
Yeah, and just by listening to that, there's lots of utility to leverage an organisation like yours, but you need to know why and how to do that. Yeah, that's where the sophistication lies. Having a good broker for introduction for that can be actually critical. So is it mainly short term stuff you're doing? Like, what's the longest term? Like
longest term we do 3 years.
Okay.
For the larger stuff, but in the smaller stuff, it's 5 year terms.
Okay.
So 1 to 5 years for the small ticket stuff. You know, sub 7 million. Yeah. 1 to 5.
So even on a more simple level, then you can borrow more. You can be in the market for the period of time. If you're finding growth assets, you're paying a premium on the interest rate for a short period of time, but you just leverage up and get stuck in and then refinance and go back to the bank. That's the play largely for probably less sophisticated commercial investors, guys like me. I'm not buying shopping centres, big shopping centres, but
you hit the nail on the head. And I think sometimes people get a bit nervous. They look at the interest rate and think, oh, it's 1% higher. But if you actually do the maths on that, or 1.5% higher, in aggregate, it's actually not much money at all if you take a long-term view of the asset. And if it means you can get your foot on a property, move quickly, maybe not have to raise as much equity, it can all sort of make sense. Yeah. Obviously, if you're super loaded and you're only borrowing 35% on a fully leased asset, you wouldn't use it. But, that's a minute amount of the market.
Yeah. And again, it comes down to doing the maths. How much of your funds is sort of warehouse-based stuff versus stuff you're raising elsewhere for people seeing this as an asset class to invest in?
Yeah, good question. Lots of high net worth money and family office in the space. Yeah. That's certainly driven. That was the sort of the genesis of non-bank lending in Australia, was the family office and high net worth market. We still have a lot of high net worth money sloshing around our business too. Over $1 billion. So a lot of these high net worths will invest in these warehouse structures as well, but they'll invest in a part of the capital stack that produces a better return than being super senior. And they're happy to take that risk if they're, participating alongside some investment banks. Yeah. And also other asset classes, things like construction loans, again, which some of the large institutions still find difficult to fund on a warehouse style basis. Yeah. So that finds a good home for high net worth money.
It's probably shorter term allocations as well, right? They're not tipping all that into a commercial asset. It means they can get in and out and be quite fluid.
Totally.
Do a deal by deal even.
Absolutely. They can come into short term warehouses, look at deal by deal stuff. And certainly over the last 4 years in the interest rate environment, a lot of these guys are getting senior debt positions paid monthly at currently 9 or 10%, 8 to 10% paid monthly per annum, and super senior in the stack. It's just great business. It's been a great 5 years to be a real estate debt investor, probably the best it's been in decades. So, but that wall of money that started to hit is starting to displace a bit of that. So they're going to have some decisions to make around taking a bit more risk or looking at other asset classes as well.
And what do you think is going to carry market share uplift for this sort of subsegment of lending? Is it going to be the need for capital is growing, particularly around commercial assets? Is it more Aussies getting attracted into this subsector of commercial lending as an asset class, and they may need sort of some more pragmatic ways to fund things? What's going to push it?
I think it'll be a bit more buying and selling, as as some sort of assets start to trade again and feasibility start to make sense, you'll see a few more development sites starting to buy and sell. Developers sort of waited to see what's going to happen with interest rates and construction costs, but now that sort of the fog has cleared somewhat on those 2 points, I think you'll see a bit of buying and selling, so that'll drive demand again. Probably a question for Scott as much as anyone on that.
Yeah, since 2021, which was like one of the peaks or the lowest interest rate point, we've seen huge amounts of developers come to our business to go through the passive investment route, because we're speaking of
these people who normally develop are going, no.
Developers are not developing, essentially. Obviously, the cost of building went up massively in that period. There was uncertainty around the economy. Then interest rates went through the roof. That would have probably put more pressure into, giving you a lot of work as well, because people couldn't refinance through the traditional banks. And people were, either just keeping projects going for the sake of employing it, or, keeping their foot in the door, or just pulling it completely and buying a regional shopping centre or an industrial site. A lot of the times below replacement costs too.
Yeah.
But now with interest rates dropping, the build costs scenario is stabilising. It's, like you said, people are getting more active again. So maybe the window of developing for the average person is starting to look a bit better than it has been. Well, it's definitely looking better than it has been, but is it there yet? Probably not, but it's getting there.
It's patchy. So in places like the eastern suburbs of Sydney, where a lot of the cost in a project is in the land, not so much the build. The build's still expensive, but the land's the big driver of the overall cost. Those projects are still making sense. But if you go further west in other areas where the major cost input into a project is the build cost and the land's relatively cheap, as a percentage of the overall cost structure of that project, still damn hard to make those projects work. So again, it's pretty patchy out there. But Scott, I think you're right there. If a lot of investors, if they can not take development risk and earn a good equity return on their investment without taking that development risk, whether that be planning, construction costs, and then ultimate lease up and sale, if they can make a good return without taking that risk, it's been a good move for some investors.
It all runs in cycles too. Like, you think if interest rates drop further, and I'm keen to get your thoughts on interest rates, it's going to basically make development more viable, and most importantly, it's going to push asset prices up. We're already seeing it in commercial. There's quite rapid growth in certain markets at the moment. In 2021, 2022, prices dropped because interest rates started going up. So basically, rents were going up in that time, but yields were expanding. So that kind of decreased the value. And now we're seeing them all go up. And think about it, every time the price goes up, your development margin increases with it. So naturally, the market will create an opportunity to develop again. But like you said, Dan, it doesn't stack up in most markets unless it's blue chip.
Yeah, there's got to be a kick in values to justify these projects starting. And, if interest rates keep going down, and God willing they will, then you'll get more buyers who can afford to cease renting, pay a deposit and buy. But it's that kind of market that needs to start kicking up the end values to make some of these projects work. Until that happens, a lot of projects are still a bit stalled because the feasibilities don't make sense given where build costs are at the moment.
And how closely do you follow the interest rate cycles? Is that a big part of your business, or is it just business as usual for you?
Yeah. We try not to crystal ball it too much. Yeah. We sort of just get on with life, and they'll do what they're going to do. So sort of our view on it.
So in New Zealand, because obviously you've got offices over there, it's amazing how more extreme it was there.
Yeah.
And it did affect the property market like much more severely. Like, there was price falls of 30-40% for certain commercial assets, and resi for that matter. And it's one of the reasons we expanded there, because I was going to look into that business in 2021, and the yields were like way lower than Sydney. And yields, it was just, there's no mathematical sense to invest there. But then all those interest rate increases dropped the prices, and now you're having a severe rate cut cycle.
Yeah.
It's looking pretty good over there, but they don't feel like that, do they?
No,
locally.
The Kiwis have got form here, and that they're always the first to hike globally, and then the first to cut globally, and they hit their peak interest rates in May 2023, and I think they hit 550 as a cash rate. We hit, was it 485 in December? Was it whatever it was?
425 was it?
Whatever it was.
I'll just nod. It's one of them.
In December. So they went way harder than we did.
Yeah.
And they went way earlier. So, and that did some lasting damage over there, because what it did is it ate into so much equity for a lot of asset owners. And so when the Reserve Bank thought that, okay, we'll cut interest rate and hopefully, it'll settle things down and off we go again, actually they've dropped interest rates quickly. They're now at 3.25 and the 30-day bill rate's there's 3, so it's baked in another 25-point rate cut.
Wow.
But unemployment's still ticking up, and a lot of equity's been torched, so there's not that much depth of market there. No. So, if you take a long-term view of New Zealand being a good place to invest, and I think it is, it could be a great time to while the market's sort of sloshing around the bottom, in my humble opinion.
Yeah, well, we were looking like Auckland industrial assets, and these are yields probably 6 months ago. We had old valuation reports from 2021. It was sitting at sort of a cap rate of 4.5%. And we're buying the exact same property at 6.6.
Unbelievable.
And the rents have gone up. So that's a massive differential.
Replacement
price.
cost has gone up hugely as well. Build costs in New Zealand are expensive. It's just that there's not much buyer competition there now, because everyone's sort of looking after their own portfolios at the moment there. Yep. So, you're often buying assets there, I think, with not much competition, which is a good time to do it.
Your biggest competition's the vendors themselves. As soon as the rates drop, they're just expect, like, we're midway through deals and then the rates drop and they're like, oh yeah, I want more money now. It's like, well, we're still the only buyer here. So that's a big battle at the moment. But you're so right. There's a lack of competition, and they'll get in like most markets do. Like the masses will, when it's too late,
When they've got that new visa program over there that's started, and so they're offering foreign investors permanent residency if they invest up to $5 million for 3 years. So that some of that will find its way into the system. But, there's going to be a lag there still.
Yeah.
It's mainly Yanks coming out of Silicon Valley, sort of.
I think so. Yeah, just an end of days scenario, is it? Just in case. Peter Thiel's got a place in Queenstown there.
Yeah.
What did it?
I could see why. It's great. I could detect a small accent. You're originally Kiwi?
Small, is it?
Yeah.
Yeah, mate. I grew up in Christchurch, New Zealand. I've been over here 20 years.
Yeah. And how different are the two markets? You obviously operate in both of them, and we sort of went into some of the specifics around the dynamics of the actual assets at the moment. But from a mindset point of view, do you think Kiwi is a bit more open and driven towards commercial property? They're still in the dark ages, like most things in New Zealand.
No.
Sorry, I had to do it.
No offense. No, there was a huge syndicator market there. So a lot of property syndicates up there, over there. The old vintage of that investor market has probably had a pretty rough ride over the last 5 years, because as Scott mentioned, the yields were super low, but then interest rates went up, which meant that all the free cash flow had to go to servicing interest, so there's no dividends getting spat out. So they've had a bit of a rough ride, but they're very used to investing in real estate debt. It's a big property country over there, and there was no stamp duty and capital gains for a long time. Yeah. So people could buy and trade.
There's still no capital gains.
Still no cap gains. It's bizarre, isn't it?
It's crazy.
But that's just the way it is. So Kiwis are well across the property investment space.
Yeah. How does capital gains work if you're an Aussie investor? You got to cop it back here if you tax domicile here.
There's treaties there. Yeah. Like, we need an accountant to go through it, because it is quite specific. But like the basically my take high level is you lend about 10% less on the LVR. Most of the rest are the same things, but there's benefits like no capital gains tax. There's what's the other big one? There's no stamp duty. That's significant. So even those two things alone make it a pretty worthy case. And now interest rates are basically the same. When we started investing there, the average commercial rate was 9%. Because they have a bigger margin over there. There's less banking competition there. Even though a lot of the banks are the same as Aussie, it was just a terrible place to lend, but it is getting a lot better. And I think it's going to go the way of Australia. They'll end up doing the same or similar LVRs, because they are a little bit behind the times. And once the market's gone the right direction, banks will want a piece of it for their market share.
And a big shout out to all our Kiwi listeners, and we've got a big following out there. And
We just offended them.
That's all right. We know we're good friends. I'm a big fan of. I've just come back from New Zealand a couple of weeks ago.
Where'd you go?
Queenstown.
Oh, lovely spot.
It's great. No, every time I come back there, I start looking at a property thing. I'm going to buy something.
Yeah, a lot of Aussies over there too.
I'm still toying with the idea. It's so easy to get there. It's lovely. Yeah. Like the Kiwis, it's good fun. Even though commercial markets, it is pretty good. No, everyone that knows me knows I like the Kiwis. But and Scott, just to pick up something you said that a lot of developers were buying assets. They will stop developing. They'll just park their money.
Yeah.
When are we going to start seeing them trading to liquidate capital to get back in the development side of things? What do we need to see other than interest rate shifts?
Well, it depends on the market. Yeah. So I've got a lot of Melbourne developers and they will not touch Melbourne at all. So one of the themes are it's not just the government or the economy down there. There's a theme of like some areas it feels less safe and stuff like that. So they don't want to deploy capital into that market. Plus it's still kind of going different directions, whether it's office or retail. So they're not going to get back in the market regardless of the rest of the country or interest rates because of the vibe down there. Places like Queensland, you're going to see more development pick up as you get closer to the Olympics, and there's a bit of a wealth effect getting created there from the housing market going strong and net migration figures going through the roof. But it's all to do with the numbers. Like Perth, like the numbers look better than they used to there because of the massive growth they've had. Still costs similar amounts to build the things per square meter. But look, as long as the margins are there, and overall they're not quite there yet. Yeah. So most regional markets, you're buying below replacement cost. Most developers, the cost of debt still not making sense. And people's risk appetite's still not where it was. There's another rate drop or two. Yeah, I think we're on, and you need a bit more capital growth. So it's just time. If the markets all grow 20%, everything else stays equal, you'll probably see more people take risks.
You will see, though, a two-speed market, I think. Even if you do get a number of interest rate cuts, you may get places like Queensland firing, but I still think the fundamental challenges faced by, Victoria, particularly politically around rhetoric, changing laws around work from home and all this sort of stuff, you're going to end up absolutely with a two-speed market. I don't know what's going to happen and what's going to have to change down there to actually get developer appetite in there because
and that's the biggest problem with the country here, all these first home buyer schemes, and it's all garbage to just address the demand side of things. There's nothing there for supply. Like we need more houses. Like this is not a commercial comment, but probably not keeping up with a lot of the required commercial assets as well. Like forget offices, but what about critical infrastructure or medical centers? And it just doesn't, they don't stack up. And I see a lot of these like fund through projects where they're trying to sell childcares at 5% yields when you can buy an existing one with a business there at 6%.
Yeah.
Why would you fund through it? It's like, we're 20% off, and really a lot more than 20% because you want a margin on top of that development to stack up. So it's a bit of a global problem. I think it's, But
it doesn't actually buy votes, though. That's why you don't hear much about it. But let's not get into that.
Yeah.
Today, what I am curious about is, Dan, is you said you got a couple of hundred people working for your firm. How much of those people are sitting there who are like legal type people doing contracts and making sure that you get your money back and making sure security good, all that sort of stuff, versus, the finance boffins who are looking at actual deals and making the numbers work?
Yeah, well, we've got a good mix of all that. We've got our loan originators that are, our front line are out there dealing with brokers and borrowers and are finding the loans and doing an initial underwrite on those loans to make sure they're worthy of taking the next stage. And then you've got, our underwriting team or credit team that, make sure that the loans are fit for approval before they go up to get signed off. And then you've got a bunch of folk that manage those loans to ensure that we get repaid. And then you've got a recoveries team because occasionally they don't all go to plan and you've got to recover the funds.
Yeah.
So, it's a big old machine. We've also got a development management business that has got a large development pipeline as well that trades under a different name, so that those staffing levels reflect that business as well. So it really is a large machine now. But in these, when you're sort of doing 20 plus loans per month, and if they're in a shorter duration type loans, you got to have that team, that head count there to manage those shorter duration loans.
The critical point is education around it, and you're only sort of 12 to 13% share of the market. Yes, you've done a lot of deals, and there's a long way to go for market share, but there's still this sort of inherent maybe misinformation or disinformation around non-bank lenders, second-tier lenders. A lot of people still, and the banks will tell you this, flight to the safety of the banks. Scott, for you, there is I guess some elements about a risk using private credit, especially if you're sort of long-term investors focused on stuff. So for good transactional, quick stuff, I can see it.
Yeah.
But how would you sort of balance those two things to know when to use sort of private credit, private lending?
Well, look, we're generally quite conservative investors. So we're passive. We're not doing short-term flips or anything like that, because that makes total sense. Everything you mentioned, like if you've got a value-add project where there might be 15% uplift in, sorting out a lease, but you can't get that deal because you're not quite there yet. Like, 100% jump into this. You won't, because of the extra interest rate and the extra LVR, you may not make money that year, but then you're in the asset. So that makes more sense. Like where it wouldn't make sense is if you're buying like a childcare 15-year lease at 6% return. If you're that stretched, you just got to lower your budget. It's not worth it to, I guess, get into a position where you need to refinance 12 months later. Just take a breather. Like the markets aren't out of control at the moment as well. So it's probably our strategy doesn't reflect the need for this type, but if there's a value uplift and you've got a high risk profile, getting in it can make all the difference.
Or leveraging your portfolio to buy something else. Just you've got a bit of equity you've built up. Banks might have issues releasing it. That's another option. Gear up.
So you just take secondary positions, second mortgages.
We do that too. Yeah, we do that. We sit behind some of the major banks on larger stuff, so larger development projects and things like that. Yeah, we do. We've got a second mortgage product as well.
What kind of percentage out of your business is construction versus just plain old commercial purchases?
45% is construction. Yeah.
And have you found that actually reduce in recent years, or?
We went through a patch in 23 when we didn't do a construction loan for about 8 months.
Really?
That was because, there's a bunch of builder failures sort of rolling through the system. Construction costs were pretty out of control. It was hard to get a handle on a builder pipeline when you're doing your due diligence on the quality of those builders. So a bit of nervousness there. But, we've come back with vengeance in 24 and 25, and we're doing quite a bit of construction lending at the moment.
Because you'd be a good forward indicator of where the market's going as well. Like, what are you seeing, I guess, the growth in your client base? Like, what are they actually targeting? What type of assets and even areas? Is it totally random in nature what you're dealing with?
This is boutique projects, nothing in the CBD, apartment buildings of, 10 to 40, medium density sort of stuff is still being really well received by the market. There's a bunch of good builders still in that space. There's been some new building companies start up with their new building companies, but they're staffed by great people out of some of the major builders. So there's been a bit of a rebirth, refreshment in that space. So we've backed a bunch of those new building companies.
What's have you had any horror stories with private funding, even outside of your business? What happens when it goes wrong? Well,
you've probably read in the papers. There's a couple well documented ones in the papers there that I won't dwell on because I don't want to put the knife in. But there's been some loose private credit lending out there that's resulted in some losses for investors in those assets. But it comes down to picking your investment manager and your track record and meeting the people that run the business and understand their systems and process and governance and things like that. And also, if they've managed to attract institutional capital within that business, you can bet your bottom dollar they've been through the ringer in terms of having investment banks pour over their systems and processes and making sure they're well capitalized to run these kinds of businesses.
No. What about big wins? What sort of a project you're seeing someone take a crazy risk and it pulled off?
Well,
do you get more winners than losers?
Yeah, of course. Well, we're a debt house, so the house always wins. So we're okay. But we've seen some borrowers lose a bit of money for sure. But most people, worst case, they might dust a little bit of equity and then they can carry on and live to fight another day. But that's more development finance, where you're taking a bit of risk around what the market's doing at the back end. Maybe they've had a builder not perform on the way through, had to replace the builder, costs a lot of money. But generally speaking, the markets, we've not had a lot of tenants leave on assets. The commercial property part of the books perform beautifully. So, generally the tenants have, gone well. I haven't had a tenant go broke on the book as far as I know.
Yeah. And big wins? Like, have you seen someone sort of buy a crappy site, barely afforded it, put a DA uplift, something like that.
Long-term options.
Yeah.
There's a bunch of potential wins coming through with these LMR planning changes come through, but I've seen some great deals where people have bought and found long-term tenants between buying and settling. Yep. Just bought long-term options on great industrial properties where the market's just come through. So you're seeing huge wins.
Yeah. So outside of getting a bit lucky, like what's a unifying factor of those people that win more often than lose? Like, what do they do?
That's a good question. I think they buy themselves time.
Okay.
So they'll take longer settlement views and then they'll work their asses off through that period to add value. And that's probably the common theme there. And they'll add value either through getting a DA that people thought may not have been possible. They might get a large pre-commit that they thought may not have been possible. It's those sorts of things that they add value through the journey. Or they might put together, get to that 75% threshold in an apartment building so that they can also acquire the last 25%, those sorts of things, and unlock value in those kinds of assets. So, there's a lot of work that goes into those kind of plays, and sometimes it's just dumb luck as well.
Yeah.
It's such a common theme, isn't it? Like everyone thinks it's passive, but it's not. Like all these uplifts, you've got to work your ass off in the background to actually have a chance.
Well, I think also is that a lot of people think it's very glamorous being a commercial property investor or a developer, but it can be blood sport. Like, you got to be, if you try and go down a compulsory acquisition pathway, often you're not making friends.
No, and you may not get it all. Yeah. So there's a lot of risk involved. Between when you think you've got an idea to buy a site and deliver a great project and actually exit out of it, a COVID, a building failure epidemic, all these things can happen. So there is a bit of luck involved from when you buy it to when you actually deliver a project. It can be 5 years later. And the market can change for the better or worse. So it is a lot of, it's a bit of a chances game.
Not for the faint-hearted. Do you think builders make good developers?
Not for sorry, I thought you guys made good money. I was going to say the good ones make
next question.
Yeah, pretty well. They make a reasonable. I don't think they make a great margin for the amount of risk they take and hard work they do.
Yeah.
A real estate agent will make 2 or 3% on a commission. These guys will make a 3.5% margin. They'll be slaving away for 18 months if it goes well.
Yeah.
So, or maybe a bit better than that.
And haven't you seen in all other professions, they think, I want to be the business owner now, I want to be the guy in control, I want to be the person who is calling the shots.
I've seen it work really well, especially if they've got one project on the go or two projects on the go and they can just focus on that project. I've seen it work really well.
But overstretching normally can get problematic.
It's actually been the flavour of the month over the last sort of 24 months. Banks particularly like the fact that if an owner-builder was delivering a project, that they could look at the builders' assets and liabilities, know that they're focused and aligned to deliver that particular job and didn't have too many other distractions building other people's projects. That became a very strong credit risk mitigant for those projects. So it's actually been a pretty good thing. But historically, banks and non-banks have shied away from owner builders, but during that construction cost escalation phase, it was actually a preferred a preference.
When you're doing the lending, like feasibility on it, do you actually see the margins they're aiming for in projects?
Yeah, often we do. We get a quantity surveyor to check the build cost, and we've got development experience in house, so we work out. We've got a pretty good idea what those margins look like. We want the builders to make a good margin. They need to stay solvent. It's the critical part of the whole project, really. So, we develop a lot of real estate too, and we want our builders to be successful. We really do. Yeah. So we don't want them to price it too thin because it causes issues for everybody if they've got it wrong.
And in terms of numbers, what are you seeing in terms of builders' margins? Like, does it change depending on the price point as well?
No, I mean they'll probably target sort of 4, 5, 6% margin as an absolute minimum, and then they hope that they do a bit better. Trade letting during the project and maybe get that up to 10, 11. Yep. That's what they're aiming for.
And that's based on no capital growth, or is that part of it?
No, they're just a fixed margin. That's what they're hoping.
Today's prices.
Yeah, today's prices. Yeah.
Conscious we're peppering you with questions. You're handling them pretty well. Your craft. And I'm thinking about risk. So for an investor like myself who wants to sort of invest in commercial property, start sort of thinking about developing, whether it's, developing commercial or sort of, unit blocks, which sort of fall into a sort of commercial premise. Where does that risk lie? No doubt you secure against the asset itself, but you'll take other securities against that. Like if it all goes wrong, how can people find themselves unstuck?
Well, we typically focus in on the main property. That's our primary security. We do have a look at things like assets and liabilities and other assets they've got to gain some comfort that they've got financial capacity to fix a problem should a problem come up. But I think generally speaking, if the buyers of these smaller assets, sub $10 million or sub $15 million, as long as they understand what the risk of the tenant moving on is and what the market to get a replacement tenant looks like, and perhaps what an incentive might look like if they had to fund another fit out or take a rental abatement, could they hold the asset through cash flow whilst they got through that phase? If the answer to that's yes, and the rental growth keeps kicking up, then the yields that these things can put off are much more attractive than residential assets. And we own a bunch of commercial real estate and Double Bay, and our net rental income there for office assets has gone from about $1,200 a metre to about pushing $2,000 a metre over the last 5 years. So if you get it right in a good area, you can do incredibly well out of it.
Yeah. And for you, Scott, working with commercial clients who would normally go down a traditional pathway, you're here in resi lending, getting to the market faster means that you can be in there longer for capital growth type assets. No doubt the same thing applies in and around commercial. But what else would you be weighing up if you're considering sort of private lending options versus stick around waiting for the banks to give you the dough?
Well, it changes depending on the market. But like right now, we are seeing the market move in certain spots. So look, the small part I'm picking up is just the higher LVR. That is extremely attractive to people because if you can acquire and hold a higher value of real estate for a longer period of time, or even do a small little value add, wait for a rental increase, and then get back to a standard interest rate, you'll make more money long term doing that for sure. It's just every extra $1 million of property you can hold long term, if you get 7% on that over the compounding forever, plus you're getting a cash flow margin on that as well for commercial, it's a really good return on equity. So yeah, acquiring a higher value asset would be the number one thing I'd be looking for. And a lot of investors aren't super sensitive to, I need my cash flow year one. Like we are probably the most sensitive in the market because it's one of our points of difference as a company to get good cash flow. So we're not buying the likes of Double Bay and, those super sharp yielding markets. But it makes sense if you can buy more property and just refinance out of it.
So that would really shape the brief that you get, because if you can, to your point, the high LVR means you can do more with your deposit, means that you can buy a higher value property. Yeah. It's going to come down to what sort of negative cash flow you can carry for a period of time. And no doubt you'll probably try and center it to neutralize it, but you need to know what capacity you have to contribute.
Or like if you target a higher yielding one, like you mentioned, it's 1.5 extra interest rate basis points, at 150 basis points, should I say higher? So that means 7.5% interest rates circa, and that changes depending on the month at the moment. But, if you find an 8% net yielding asset, you're still covering your costs. Yeah. And then, you got a higher LVR.
So you'd recommend then, no doubt, preface this with a disclaimer, but getting in the market earlier and or getting a high value property by securing a shorter term view towards private credit and just waiting for a period of time if you buy well to refinance out. And that's what you guys want as well, right? You want the deals to turn over.
If it's a super, secure asset.
What quantifies super secure asset?
A super secure asset would be long leases, good market, easily relet. And that's a very hard thing to get your head around because even an easy to relet commercial property could be 3-4 months. Yeah. Might be longer.
Costs as well to relet.
Yeah, so you've got to factor all that in. But look, the market is going the right direction, in my opinion, is because of the interest rate cycle. There's still huge immigration levels. We've got a shortage of good quality property. That's the key word for commercial as well. Like even the office market, which is something we barely touch, there's pockets where it's almost there's no vacancy. Double Bay is a perfect example. Look, see that rental growth. I assume that's office at 1,200.
It's all office, yeah.
To 2,000 a square meter. Like if you had a piece of that, that's massive growth. So, not every asset class can have its day, and just getting into the market and holding through that will make you money.
Okay, we covered a lot. No No doubt it's going to pose a whole bunch of other questions for everyone tuning in. You can always speak to the team over at Rethink. We've got some burning questions here, which we go through. And these are questions coming in, a lot of it through all the social media channels across Rethink and elsewhere. So we'll get stuck into some of them. Dan, there's one here. It's probably for both you and Scott. How do companies like Rethink and Pallas help lower level investors build to 200K property incomes? So imagine that sort of trying to buy that in rents. How low will you guys go? Like when does it become worthwhile for you to start funding?
Historically, we've been at $1 million minimum, but we've got a new product that specialises in that sort of 600, 500K up to $5 million range at the kind of pricing that we've been discussing today. So, anywhere around that.
So it's meaningful for you to still do that.
Yeah, for sure. Yeah.
What LVR is that sitting at?
Mid-70s.
Yeah, that's pretty good.
Yeah. Yep. You can find, we've spoken about it, it's tough to find good assets, sub $1 million these days. So
very difficult. And look, that's like the way the market's going, commercial is getting a lot of capital growth and extra attention. And we know how much larger the residential buyer demand and market is compared to commercial. So that space is getting awfully crowded, which is probably why I'd almost say residential is just getting more and more important, because you do your 90% or 80% loan in that, build your equity through that, hold it for a few years, and then refinance your 3 or 4 houses and go larger in commercial rather than starting off small. But yeah, those who might have a large portfolio of resi, you could look at refinancing or just selling off a couple, and then you're not so entry level all of a sudden. Like, we've spoken about your portfolio. You've done a few of those things, as I have as well. Selling off residential gets rid of negative cash flow, so there's a benefit there, and then you turn it into a positive. It's like a double whammy. So that gets you closer to 200 as quick as anything.
Yeah. And there's a question here, which is, what's the strategy for first-time investors to build quickly if they only have limited budgets for commercial? So you sort of mentioned that. Sell some down, get some capital together. So if you're looking to build quickly, you want to be chasing higher LVRs. So that's when you'd be attracted to private capital.
If you're lucky enough to have like some big inheritance, or you got a business and you've got a big chunk of deposit, you can create an instant 200 grand passive income with one commercial purchase.
Yeah.
And we see that a lot, and there's going to be a lot more of that as the baby boomers start handing their wealth to the next generations. And, that's a way of instantly creating an income.
So quick sums then. What do you need to one times purchase? What's the asset value to give you a couple $100K a year in your kit?
Well, look, let's just use round numbers. If you've got a $10 million commercial property, there's $700 grand of net income on that. If it's a 7% net income, interest rate on, let's just assume 100% finance on that, like 500,000 or 550,000 in income. So that goes out the door because of interest rates. So even at 100% debt, 700 minus 550 is 150 passive income.
Okay.
But assuming you got some cash in there, so every bit of chunk you put in there, it's going to turn that into a 200 grand passive income pretty quick. So you just need the ability to lend, and you can do lease stock loans, which means you can get a loan without a job as long as you've got the capital. The income on the commercial property's got to be strong enough to have your 1.5 interest rate covers. It's got to have a WALE of, call it 3 years, so you can get a loan on the length of the lease. And it's not as hard as, you just need the deposit. That's what
it all comes down to.
All comes down to that. If you got that, you're there.
You're flying. And just quickly, there's no question around this, but I'm curious around with brokers. So you're speaking to a mortgage broker. Do you sit on like aggregator panels, or is it more of a private relationship? How does all that work?
Yeah, we sit on aggregator panels. So we're on like Loan Market Group and a few others. So yeah, we're all across those.
So if you're tuning this, you can actually ask your broker, hey, have you heard about these guys?
Totally.
Yeah. Okay. Something in it. Scott, what are the advantages and disadvantages of buying industrial units off the plan?
Advantages, lower price point. Is great depreciation, maintenance is low, no capital expenditures needed. It's almost one of the only options in the sub $1 million range at the moment. Okay. You have to deal with other developments in the area, so you've got to understand the supply of the market quite well.
There's going to be a lot more of it if someone's just started developing.
And it's not predictable too, because other projects could be released. There's certain pockets around the country where off the plan is brilliant, and then there's others that all of a sudden there's 50 units on site, and then that might take 12 months to get absorbed into the market. So that's a negative. Like it's just the absorption period of it getting let up, as well as owner occupiers taking them out. In many areas, owner occupiers pay a premium for vacant places as well. So it's just a leasing risk, but long term, it should be a good investment because a lot of markets, they will develop the industrial properties first because they're needed to then build the houses because they're storing building materials and workers and all that. So yeah, it's risky, but it's, if you can deal with a bit of short-term risk, they turn out to be pretty good long-term investments because they're simple. They're just walls and a roof and not much else going on.
In the middle and a dunny, a little kitchen.
Yep.
Happy days.
Yep.
Dan, one for you. You sort of answered this right at the front end, but how has the role of private credit evolved in the past few years? What is driving demand?
It's professionalised. It's here to stay. It's got huge amounts of institutional offshore support for it now. And it provides the local market flexibility and choice outside of what the Big Four banks can do. So it's been a great thing.
Is it competitive? Are you seeing sort of smart blokes and girls coming out of sort of investment houses saying, hey, we can do this alone, let's go get a warehouse facility? Is it pretty tough to get those things? Or
it's tough to get them. It'd be tough to start a new business and compete with groups like us who have been doing it for a wee while and got those connections. But, there's a core of non-banks who are really well established now that still compete every day for business. So there's enough competition out there to provide good product to borrowers.
And what about sort of collaboration with competitors, esprit de corps of trying to grow the industry despite the fact that you're chasing sort of, the next deal? What needs to happen for the private credit sort of gang to get together to push hard collaboratively to drive market share, or just happen through osmosis, do you think?
I think so. It's pretty collegial. I know the owners of most of the other non-banks and the market. You compete when you cut up against each other. But everyone sort of often has their little niche too. So we sort of focus on that $1 to $50 million spot. A lot of the more established non-banks out there focus on $50 million plus. So you tend not to cross each other too much for the major players. But I think you're always better to chat to your peers and see what you see in the market and try to share intel, and hopefully you can learn a bit off each other. Yeah.
Is there a pecking order when you go to sort of industry functions? Do the banks sort of look down their nose at you blokes?
I think probably 5 years ago for sure, but now it's the other way around, know.
They're all asking you for jobs, no doubt. Now.
Well, they are. And, we drive the nicer cars for sure.
We'll finish with this, Scott. Are we seeing a shift where private credit is reshaping commercial investment outcomes, or is it still a niche solution?
I'm sure it is, just not in our space. It's probably a bigger thing in the value add, fund manager space where, like you mentioned, there's 50 to 55% debt levels, so that it makes more sense in that space. But yeah, it's pretty safe and sturdy. Like the banks work for the passive investor. So yeah, the higher LVR is probably the biggest thing that would be there, but because interest rates are higher, you don't really want to keep pushing higher again because the yields won't stack up at that point. So for us, not huge, but we're aware it's a big force and it'll keep getting bigger, as Dan mentioned.
Yeah, and the key thing for investors, and this is obviously all around access to finance, there would be a solution for you if you go looking for it. And if you're going directly to a bank, you're probably not going to find it there. So make sure you're speaking to your mortgage broker. And if they don't have the skill sets to be able to navigate this, there will be mortgage brokers out there that do that. I know your gang is pretty sophisticated, and you no doubt chat to them. But you're happy people, you going to go for brokers, or people can come direct to you guys? You happy to?
Both, both. We big in the broker market.
Yeah,
and people come directly.
Yeah, okay. How do people find you? What's it like? Pallas Capital, Google it. Yeah, track it down.
That's
find it.
PallasCapital.com.au. Yeah.
Trained operators are standing by. Well, you guys have done some big deals, and you're obviously onto something. With this, Scott, we might have confused a whole bunch of people today, so they can dial into your crew and ask anything.
Yeah. We're across this. Remember, all levels of property is a game of finance. So if there's another option to consider, it's definitely worth putting it on the table. So yeah, if you just want to have a chat, just reach out to rethinkgroup.com.au, and there's the finance team, there's the buyers agents, the legal, whatever you need, and we're just keen to keep chatting.
Yeah, nice one. Well, thanks again. Thanks, Dan. Nice to meet you, mate.
Cheers, guys.
That's really good.
Thanks.
Thanks for tuning in, everyone. We'll see you again next time. Until then, bye-bye.